Hi everyone, why dividends now? Because inflation. New release of the CPI number is exciting for the market and investors. But the most recent read of 7.7% is still relatively high. It is natural for investors to be concerned about the potential impact of high inflation and the rising interest rates on portfolios. However, dividends paying stocks can offer crucial balance and additional income to a portfolio, especially in today's high inflationary environment. Additionally, dividends payment may also help ease the volatility of the return in a portfolio. Let's look at the chart. From 1928 to 2021, during high inflationary period, the dividend paying stock had generated almost 2.5 times annualized return compared to non-dividends paying stocks, 10.2% to 4.11%. But when you have it in the mid-inflation period, and dividend stocks pay 13.5% annualized return, and the non-dividend stock actually have better, 15.21%. Now the low inflation period, below 1%, the dividend stock make 5.43%, but non-dividend stock actually have a minus 0.15. Hope this information helpful. Thank you for your time. Thank you for your watching.
Good morning, everyone. Happy holidays. This is Rob McDougall from Zhang Financial with your weekly economic update. Today is Tuesday, December 27th, 2022. So last week we had a number of high-impact economic data points that came through. There were 4 that were housing-related, 2 were inflation metrics, and we had personal income and personal spending. So last week, again, we had 4 data points that were housing-related, none of them good, all well down from 1 year ago. The one thing that was interesting, though, is new home sales. That was released on Friday for the month of November. New home sales have actually rebounded off the bottom, which was October. It was 559,000. That rebounded to 640,000 in November. I think this is starting to show an impact from 30-year mortgage rates that skyrocketed earlier this year and now have leveled off. So when we started the year, 30-year mortgages average was 3.05%, hit a peak of 7.08% in November, but now has come back about 75 basis points or a little more, is now at 6.27%. So hopefully that will spur a little more activity in the housing market. So other data that hit last week, we take a look at personal income and personal spending. Both of those metrics I thought were really good. Now the market, will see how it responded. It was relatively flat last week, but I thought this was fairly decent economic data. Personal income came in month over month for the month of November at a positive 0.4%. That was a little better than consensus, which was at a positive 0.3%. So it didn't quite keep up with inflation, but also I would suggest we're not really going to see inflation that is being driven by wage increases at this point. So personal spending also released on Friday, very modest increase. Now the month before, October, was a positive 0.9. So we're worried about inflation, we're worried about too much demand. So November was good. On the Goldilocks side, it was just right, I think. It was a positive 0.1, which is where consensus was, positive 0.1. So let's take a look at the impacts, economic data that we've had most recently. We just mentioned personal income, personal spending, but GDP expectations. So we love watching this. The Atlanta Fed, the Fed Now, they put out their expectations for the fourth quarter. They revise it every week, and I'm often surprised by these changes. So I just talked about personal income, personal spending. Nothing there to suggest acceleration in demand. However, the Atlanta Federal Reserve took their expectation up for fourth quarter GDP from a positive 3.2% to 3.7%. Now that really is in contrast to many economists such as the blue chip forecast that the Atlanta Fed actually puts on their press releases, which is just barely over 1%. So I'm not sure what the Atlanta Fed is seeing, but they are expecting very strong growth, GDP growth here in the fourth quarter. And you may recall, third quarter not only was strong, but was revised upward recently to 3.2%. The inflation side of the equation, we got two data points last week. I thought both very positive. PCE core, personal consumption expenditure, and personal consumption expenditure core. That is a measure that the Fed prefers versus the CPI, which is more widely used. But the PCE came in month over month at a positive 0.1%. The consensus was a positive 0.2%, so a little lower than expected. Same thing for PCE core. It came in at positive 0.2% versus an expectation of a positive 0.3%. So both of those, I think, very favorable. And inflation expectations down a little bit last week, meaning expectations went up just a little bit. Bottom line is expectation for the next 2 years on the 10-year break-even chart that we show every week, 2.2% is the expected average inflation over the next 10 years. So, market reaction to what I perceive to be relatively good economic data last week was muted. Equities last week closed pretty close to flat, the S&P 500 down 0.17%. The thing that does, I think, fall out of it, or that was pronounced last week, is again, growth really struggled, value held in well. So last week, growth was down 1.89%. Value was actually up 0.84%. So on a year-to-date basis, value has outperformed growth, U.S. markets, by nearly 36%. Again, I bring this up only because it's really good for Zhang Financial client portfolios as we bias our portfolios more towards value versus growth. International stocks, which have been staging a bit of a relative rebound over the last few months, international stocks were a little bit better than the U.S. market, actually up 0.46%. That's the MSCI All-World ex-U.S. indicator. That has been the case for the last couple of months, so we're seeing kind of a stealth rebound, I think, in the foreign markets at this point. Lastly, in the fixed income side, bonds gave up some of the recent gains last week. It was fairly significant. The 2-year yield was up 14 basis points. The 10-year yield was up 27 basis points, leading to a Bloomberg aggregate bond index that was down about 1.5% last week. So this coming week, we obviously holiday shortened, so they hold off on a lot of the economic releases. The only one of note that we know of, initial claims coming up on Thursday. So initial claims, the job market, you've probably seen some relatively high-profile cuts being made, particularly in the technology area and some in the financial services area. But that's not really flowing through to the aggregate numbers. So jobless claims this week, or for last week, are expected to be about 220,000. They were 216,000 the week before, and this rate, 220,000, it's roughly in line with what we've seen all year, but it's about at the same level that we saw back in February of this year, June of this year, a couple of other times. So bottom line is, despite the fact that we are seeing news of layoffs against some high-profile companies, we're really not seeing that across the board, and certainly not seeing it in the manufacturing sector. That is it for the economic data last week, this week, and market returns. Thank you very much for spending time with us today. Hope to see you again next week, and Happy New Year's in advance. Thank you.
Thank you.